Welcome to the Deep Dive. Today we are locking onto a bit of a financial paradox. A textbook earnings beat that, well, it resulted in an immediate and pretty sharp market sell-off.
Exactly. We're zeroing in on TD Synnex Corp, ticker SNX, following their FQ4 2025 earnings call. That call happened pre-market on Thursday, January 8th.
And our mission today is really to cut through the noise. We're going to analyze the headline success. We'll dissect the true drivers, especially that high-octane growth in their solution segment. And, most critically, unpack the financial nuance that caused the market to completely diverge from what were reported as record results.
We want to know what investors were so afraid of, despite all the celebratory numbers.
So let's start with those numbers, because on the surface, they looked fantastic.
Genuinely impressive, yeah.
I mean, undeniably green across the board. TD Synnex delivered a very strong beat on consensus. If you look at non-GAAP EPS, they reported, what, $3.83?
Yeah, $3.83. And that was a comfortable beat of 10 cents, which, translates to about 2.7% over what the street was looking for.
Right. And revenue was right there with it.
Oh, absolutely. The company brought in $17.38 billion, just blowing past the consensus of around $16.93 billion. That's a $450 million beat.
And a strong beat, coupled with 10% revenue growth year over year.
So when management emphasized these were record results, they weren't exaggerating. They even hit record gross billings, $22.5 billion, up 13.5%. For a distribution business, those are huge numbers.
It seems like that news should have sent the stock soaring. And, well, initially it did.
It did. The stock opened higher pre-market, up maybe 1.9%. But here's the paradox. Almost as soon as the regular session started, the whole narrative just flipped.
And this is where it gets really interesting for us. The stock traded down sharply. It just abandoned that good news, hit an intraday low of $144, and settled right around there.
And the volume tells the story. It was nearly double the average. We're talking 1.19 million shares traded.
That kind of volume spike with that price drop, it's just definitive proof that investors were actively selling based on something they heard during the call.
Right. They weren't looking at the past performance. They were focused on forward guidance, margin sustainability, or, and this is the most likely culprit, the balance sheet mechanics. It's a classic case of looking past the scoreboard and reading the playbook instead.
Okay, let's dig right into that playbook. Before we even get to the guidance, we have to acknowledge the operational strength that made those Q4 records possible in the first place.
Their strategic shift, moving away from just being a low-margin box mover toward higher-value services, it's clearly gaining speed.
And you can see that mix shift right in the segment performance. The core growth engine, advanced solutions, that's their cloud, security, specialized infrastructure.
That saw gross billings rise 17% year over year. It hit $14 billion.
And even the traditional, the lower margin segment endpoint solutions, which is mostly PCs and components, even that showed strong momentum, up 12% to $9 billion.
So the tide is clearly lifting both boats. And that scale and strategic mix, it flows directly into profitability. Adjusted EBITDA was $527 million, which is a big jump from $450 million the year before.
And the non-GAAP operating income was up 18% year over year. But, in the tight margin world of IT distribution, just hitting the numbers isn't really enough. You have to prove you're running a tight ship. What stood out to you on efficiency?
Well, two critical metrics show immense discipline. First, the cash conversion cycle, or CCC. This basically measures how fast the company turns its inventory back into cash. SNX got its CCC down to just 16 days.
And for anyone listening, a lower CCC is better. It means they're generating cash faster, which is just vital in a business built on huge scale.
Exactly. They're running the business tighter than ever. And then there's cost control. They mentioned an improved cost to gross profit ratio. It improved by 100 basis points year over year to 58%.
Which means they're getting better at handling more business without costs rising proportionally. That's a huge efficiency gain.
It is, but the geographic performance was maybe the clearest sign they're just aggressively taking share.
Right. Where did management say they were seeing the biggest acceleration?
Europe was actually a surprise performer. Management said they grew faster than expected there, which means they're grabbing share in a market that's only growing at a mid-single-digit pace.
But the real star of the show, the key growth engine, was the Asia-Pacific and Japan region, or APJ.
Absolutely. The APJ segment delivered high double-digit growth. And this wasn't just a rebound. Management explicitly said they gained significant market share, especially in places like India. And it's all being fueled by cloud expansion and AI infrastructure.
And the real financial nugget was the profitability tied to that growth.
Exactly. They clarified that the revenue growth in APJ was matched by an overproportional growth in operating income there. So the business they're winning is higher value, higher margin. It's not just empty growth.
Okay, so let's shift to the long-term vision. Management laid out 4 key strategic focus areas.
The first pillar is omni-channel engagement. They're basically investing in their digital portal to make it easier for partners to do business with them 24/7. They even launched a self-service AI assistant in Q4.
But why is an AI assistant a strategic pillar? Isn't this supposed to be a high-touch business?
Not for everything. I mean, think about the volume. If you can automate simple tasks, checking inventory, tracking an order, you free up your expensive sales engineers to focus only on the big, complex deals. They claim it's already saving customer sales teams hours per day.
Okay, so it's really an efficiency play. That makes sense. The second pillar, specialized growth, seems to be about proving they're more than just a middleman.
Right, and they had the proof points. Winning a global security RFP and being named Cisco's Distributor of the Year, globally and regionally, that's not trivial. It shows the big vendors trust them with the most complex integrations.
The third pillar was best-in-class enablement, which seemed to be all about monetizing new tech.
And this is where they're cashing in on the AI hype. They launched something called the AI Game Plan Customer Workshop. This isn't just a webinar. It's designed to help their partners translate the buzz around AI into actual orders for servers and networking gear.
Making sure they're the path of least resistance for spending on AI.
You got it. And the final pillar was just about brand visibility. But really, the true star, the engine driving the highest growth, is their hyperscaler business unit, Hive.
Hive is reported within Advanced Solutions, and it is just fundamentally changing the company's growth profile. In Q4, they said its gross billings increased by more than 50% year over year.
50%. That's transformative growth, especially when the whole company is growing at 10%.
And this growth is fueled by massive demand for cloud data center infrastructure, specialized server and networking racks from their biggest customers. But what makes Hive so transformative for a distributor?
Because it's so much more than standard distribution. Hive requires huge upfront investment in engineering, complex logistics, co-development. They aren't just selling a box. They're helping design, integrate, test, and deliver custom racks that are ready to be plugged in.
So it creates a really sticky revenue stream that's much harder for competitors to just come in and take.
Precisely. And management was very confident about the Hive pipeline. They're actively bidding on new programs, potentially onboarding new customers.
And they're leveraging things like their U.S. footprint and their ability to co-develop solutions to win that business.
Right. It's a high investment, high reward segment that is absolutely central to their bull case.
Okay, before we get to why the market was so skeptical, let's quickly touch on the macro environment. Management gave a pretty important update on the PC refresh cycle.
Yeah, the Windows 11 refresh, plus that sustained demand for premium commercial laptops, has driven double-digit PC growth for 4 straight quarters now. They expect this cycle to continue through 2026.
And they also talked about the surge in memory component costs, DRAM and NAND.
Right, and they confirmed that those dramatic price increases are currently acting as an ASP tailwind, an average selling price tailwind. So as components get more expensive, that cost gets passed on, which boosts the total revenue number.
Okay, so we've covered the record beats, the efficiency gains, the strategic shift, and this 50% growth engine. Now we have to address the elephant in the room, the devil in the details that spurred that massive sell-off.
Right. If the results were so good, why did the market panic?
It seems like it boils down to 2 complex financial modeling issues, but one was really the main trigger. Let's start with the secondary one, the gross to net adjustment.
Right. The gross to net adjustment is just the difference between the total value of products they bill, the gross billings, and the actual revenue they recognize on their income statement, the net revenue.
And the guidance for Q1 called for billings growth around 12%, a slight slowdown from Q4, so that's strike one.
Yeah.
But the bigger issue was that gross to net adjustment ticking up to 33% for Q1.
Yeah, up from 29% in Q4. And management clarified this is because of the growing mix of netted business, specifically software and certain Hive programs.
So when they sell software, they only recognize the commission or fee, the net amount, not the total value of the subscription.
Exactly. So this signals a strategic shift toward higher margin software and solutions, which is good for profit, but it results in a lower headline revenue conversion. Strategically positive, but it's messy for analyst models focused on top-line growth.
That explains some of the noise, but not the full-on panic. So that brings us to the main trigger, The free cash flow normalization.
Absolutely. The company's annual free cash flow was fantastic, $1.44 billion, way ahead of expectations. However, management provided a very candid caveat that definitely spooked the market.
What was that?
They said Q4 benefited from several $100 million in large payments from major customers that came in early just before the end of the quarter.
Ah, the classic timing issue.
Exactly. So think of it like this. Your Q4 bank account looks artificially padded because a huge check that should have arrived on January 2nd actually showed up on December 31st. It makes Q4 look incredible.
That means Q1 starts with the corresponding cash hole.
Precisely. And management explicitly guided for a cash outflow in Q1 because of this timing shift and just typical seasonality.
And even though they reaffirmed their long-term goal of 95% free cash flow to net income conversion over 2 years, the market just couldn't handle that.
That's right. They were transparent, which is good, but when you're focused on quarterly numbers, an unexpected cash outflow just screams risk, even if it's purely temporary. The market saw a short-term blip and irrationally read it as a long-term structural threat.
So that temporary noise just completely overshadowed the real momentum in Hive and APJ.
It did.
Okay, that provides all the context we need. Before our final takeaways, we reach the not financial advice segment. And a reminder, this segment is for informational and entertainment purposes only. It is not financial advice. You should always conduct your own rigorous research.
With that necessary disclaimer out of the way, if we were presenting this to a sophisticated investment committee, we would be initiating a highly targeted, deep out-of-the-money, long-term call position on Synnex.
Intriguing. Given the stock just took a hit, tell us the specific, outrageous yet plausible thesis here.
The thesis is that the market's reaction is driven entirely by these short-sighted Q1 cash flow timing concerns and, frankly, a profound misunderstanding of that gross to net mix shift. We're placing a leveraged bet that the market is just completely ignoring the acceleration in profitable share gains and the real strategic transformation happening.
So you're betting on Hive and APJ.
Precisely. We are betting on the profitable gains in APJ, that high double-digit growth with overproportional op income, and the sustained enormous momentum in the Hive business with its 50+% billings growth. Those are the two factors that structurally change the long-term margin profile of this company.
So we leverage the current weakness, which is caused by temporary balance sheet noise,
right,
to enter the position.
Yes. We're confident that their pipeline and their heavy investment in engineering will secure new hyperscaler customers and programs, which will accelerate profitability in the back half of FY26. We view the Q1 cash outflow not as a threat, but as a temporary, clear-cut buying opportunity.
And you'd anticipate a powerful breakout when the cash flow normalizes and those high-margin Hive investments start fully converting into revenue.
The short-term pain is masking long-term strategic gain. That's the bet.
That wraps our deep dive. To recap the key takeaways for you, PD Synnex delivered record profitability and billings, which fundamentally validates its strategic shift toward the higher value advanced solutions segment.
However, the immediate market reaction was totally muted by near-term financial modeling complexity. Specifically, those Q1 cash flow timing issues and the increased gross to net adjustment.
Right. And while those factors actually signal strategic growth in high-value areas like software and Hive, they introduced enough short-term noise to spook the quarterly-focused investors.
The core long-term story, though, remains centered on the continued acceleration of that high-touch Hive business, coupled with successful execution in high-growth regions like APJ, and benefiting from the ongoing commercial PC refresh cycle,
which continues to see a nice ASP tailwind from rising component costs.
So, if management is indeed gaining significant share in competitive international markets, while also pouring capital into AI enablement and expanding a unit that's growing at 50+%, this raises an important question for you to consider.
What's that?
What exact level of growth in the high-margin Hive segment is required to finally justify a permanent re-rating away from the current historically low distributor multiple? What financial metric is going to be the tipping point free cash flow conversion or the sustained operating margin expansion driven by these specialized solutions?
Food for thought as you continue your own research and look for that divergence between short-term noise and long-term strategic value. Thanks for joining us for this deep dive into the numbers.
We'll talk to you next time.